Hi, everybody. Welcome to the Carolina Multifamily Connection Meetup. My name is Jerry Sanchez. This has been about a year and a half now running since the end of 2020. December of 2020 was the first meetup. This is, of course, while most of us were still in seclusion or hibernation, what we wanted to call that during the pandemic. But it gave me a great opportunity to jump in on various meetups all over, particularly places like Asheville, Greenville, South Carolina, Charlotte, and learn a lot about other markets to invest. So as we started to move along, I thought this was a great opportunity to keep this virtual hybrid situation going on, because eventually I knew, we'll go back to in-person meetups, so I no longer can go to Asheville and obviously join in person. So the purpose of this is connecting out-of-state investors with Carolina-based investors and operators. And, probably most of us either have a connection with New York, New Jersey, and the Carolinas, and that's typically a very common theme. So everyone is welcome, but I appreciate those coming out today. And Charles Seaman is going to be our guest. Charles is going to walk us through a live deal underwriting. And before we do that, I'm just going to give a short little presentation on underwriting. And in general, welcome everyone here, whatever type of background that you have. This is for new investors, passive investors, operators. You need to understand underwriting for whatever role that you play. Typically, even if you're an LP, you're going to vet a deal out as you should, in the same way that an operator or syndicator does. So understanding the basics of underwriting and how they flow into the deal obviously is important. So just give me a second as I do a quick little presentation as I share my screen. Excellent. All right, cool. Everybody can see that, right? Okay, I forgot I have everybody on mute, so I just see shaking heads. Good. But yes, so very quickly, 5 quick steps of multifamily underwriting. Step 1 is you typically get the information from whether it's an OM or a T12. A T12 is the trailing 12 months of profit or loss for a complex or apartment asset. These is where you'll get your in-place revenues, your current revenues and expenses. You will couple the T12 with a rent roll, where you will look and find your rental income. Besides your rental income, you also want to make sure to see what other income the property also generated, for instance, storage or pet, whatever other fees that are to be calculated in your NOI. Here's also where you get an idea, looking at vacancy, bad debt, operating expenses. And one thing to know about operating expenses, a lot of them are standard and then there's variable expenses, which are very important to know, and particularly property taxes, which vary state by state, city by city. Those who invest in South Carolina know South Carolina is a point of sale state. So you need to be aware of when a property next assessed, because it could really make or break a particular deal. Step 2 is your capital expenditure budget. So depending on your strategy or your business plan, you're going to want to look into how many units you are going to renovate, the cost of that renovation, and then you also determine at what rate you are going to renovate units. This will be used in your model to quickly determine how quickly you're going to reach your new post-renovation rents. And your timing, of course, will determine how quickly you can push your rents to your goals. All of this goes into a model, which is something now Charles is going to be working on and showing us. In the model, of course, are growth rates which are market specific. Not every market will grow at the same rate. And this is in terms of rents and expenses. For example, if you're modeling something out 10 years and you use like a 4% growth rate, a 2,500 rent will be 3,600 in 10 years. So you're modeling both for expenses and vacancy rates as well. Step 4, which is very obviously a lot of hot topic right now, is finance, and what goes into that are the loan term, amortizations, interest rates, which is again, as rates are rising right now, very important. In interest-only periods, your refinance plans, and how long you plan to hold will also determine which type of financing you're going to want to choose. And finally, step 5 is your return metrics. Typically, if you're working on a syndication, your investors have a particular return metrics that they're looking for, a certain cash on cash, deal IRR or investor IRR. How you determine whether or not a deal works with you is typically backing into these numbers and then using a price that will work. So this was a quick, easy demonstration for everyone in terms of the underwriting. Now we're going to pass it over to Charles, who will give us a little bit more detail as we're going to grab a live deal and take a look at something that's out there and analyze that deal. Just a couple of quick words on Charles. A lot of us already know him. He's well known for his expertise in underwriting, but he lives in Charlotte and serves as a managing partner of the Cash Flow Champs. He's responsible for building and maintaining broker relationships and performing and overseeing the company's underwriting activities. And he's also involved in contract negotiation and capital raising to make sure that the deals close, remaining involved after closing to manage the assets so they perform in a manner that provides investors with exceptional returns. He's currently a general partner in 8 multifamily properties totaling 691 units, having gone full cycle on one 92-unit property where he helped investors achieve an annual rate of return of 19% plus. 14 years of experience, and he is also another former New York, New Jersey area resident, and he's down in Charlotte. So, Charles, thank you for coming on, and welcome you to walk us through a deal.
Jerry, thanks for having me. It's a pleasure to be here. What we'll do is we'll go through some of the things that Jerry laid out, and we'll show you how they work in practicality. Jerry, is it possible to enable screen sharing?
Yes, sir. All right, Charles, I'm going to make you the host here. I think you already have come in, so it won't be a problem.
Okay. Okay, guys, so what we'll do here is we'll start up with the underwriting. So there's a lot of different models and underwriting tools that are out there. So the one that we're going to use for tonight's presentation is Michael Blank's Syndicated Deal Analyzer. It's probably one of the more popular ones out there. So a quick overview on the tool itself before we dive into it. So you'll notice there's different fields in blue and in black. The ones in blue are designed to be edited. The ones in black aren't. They have formulas in them. Now, it doesn't mean that you can't manually override something in black, but just be aware that if you do, in addition to affecting what you see on the screen, it may also affect something on one of these additional worksheets that you won't even realize until you're a few sheets in. So if you're new, stick with blue. Okay, so that's kind of the moral of the story on that. So what we'll do is we're going to take the numbers right from the financials that Jerry said, and we're going to show you how to take the data and put them into your underwriting tool. So you'll notice here that there's a few different scenarios. That's something that the Syndicated Deal Analyzer has. We're going to take the actual numbers that the seller has in their financials and transpose them into scenario 1. So on the income side, the items we're going to be focusing on are gross potential rent, vacancy, concessions, loss to lease, bad debt, and other income. Okay, so as we go to the trailing financials. So in this particular case, we don't actually have a trailing 12. Most likely the seller has not owned the property for a full 12 months. So what we actually have is 9 months. So for anybody brand new, when you hear the term T12, the T stands for trailing, and the number after it is the number of months for financial information that you're going to have. So in this case, this is really a T9 because it's taking our 9 months of data and it's giving us income and expenses for that. Okay, so now we'll get into the actual numbers. So on the income, we're going to look at it a little bit differently than we do the expenses. So the income we're going to look at on a T3 annualized basis. And the reason we do that is because most lenders generally are going to use that same approach. Okay, so what we'll do is we'll come over to the side and we'll just do a subtotal here. We're going to take our most recent 3 months of information, which in this case is February, March, and April of 2022. We're going to do a sum. And what we'll do is we'll do a subtotal for these 3 months. And we'll just make this a little bit bigger. Let me ask, can everybody see the screen? If it's too small and you want me to blow it up, just nod your head yes. Okay, let's blow it up a little more. So hopefully that's better for everybody. Okay, so what we'll do is we'll take a subtotal here of the last 3 months, and that's going to give us the total for that particular period. And it looks like I may have went one column too far here. Let's see. And we're going to multiply this by 4. So keep in mind, guys, in order to get an accurate subtotal, you have to make sure that you multiply that by 4, otherwise your numbers are going to be skewed. Okay, you're taking 3 months of data, multiplying it by 4 to extrapolate it over a 12-month period. We're going to use that formula for all the income items, and now what we'll do is we'll start transposing the information into the syndicated deal analyzer. So gross potential rent, let's kind of start with a brief overview of each of the items. So that's going to be your top line rent. That's if we lived in a perfect world and you collected everything that you billed out, that would be what your gross potential rent is. Okay, so as we look at the financials, we're going to look for the item or items that best fit that. And in this case here, it's going to be the one in row 8, rental income. So we're going to take our total here, which is $770,982.16, and we're going to plug that in to our gross potential rent. Okay, so next thing we have here, so now this part here may be a little bit tricky, but we'll do our best to help everybody understand it. So you may look at the financials and you may notice when you look at these items on the income side, you don't see anything for vacancy. And you're probably wondering why. So the reason why is that there's 2 different accounting methods. There's a cash basis and there's an accrual basis. With this particular property, this is a cash basis. So what's happening is it's showing us the actual money that's collected each month. So what that means is the vacancy is actually built into these collection numbers. So if you had a true gross, you would notice that this number appears usually more consistent. But here you can see some wide swings. One month we have 48,000, one month was 63,000, the next month was 44,000. And the reason for that is simply how they do the accounting. So on a cash basis, what you're doing is you're tracking the income as it comes in, and you're tracking the expenses as they get paid. So that means even if somebody's paying November rent in December, on a cash basis, being the payments made in December, that'll show up on your December financials. So that's what you're seeing here. So for vacancy, we're actually going to leave it in the actual numbers at 0 on both physical vacancy and for concessions, lost to lease, bad debt, because these numbers are already baked into our totals. Now, keep in mind, guys, as you're projecting forward, you'll probably do something a little bit different because you may want to show an actual gross number, and then you can put some vacancy in there so that way it looks like a more professional modeling. Okay, so next thing we have is other income. So what is other income? Other income is anything that's not rental or rental loss income. So it could be pet fees, it could be late fees, it could be any type of income you get, laundry fees. So if you're charging a fee for something on the property that's not rent, then it's other income. Okay, so what we'll do is we'll take a total of all of our other items. We're going to take everything here in rows 9 to 12. Now, in actuality, you know what? We can add our subsidized income. You can put this actually right in the gross because this really is top line. I missed that before. So subsidy income, keep in mind, guys, is just regular rental income. The only difference is that instead of being paid by a tenant, you're receiving that money from an agency or a nonprofit organization that's subsidizing the rent. Okay, so we'll take our totals here and we'll plug these in. So for rows 9 to 12, we have a total of $13,093.76. And then as we come back to our financials, our next one here is we have CAM utilities, which is actually a credit. So this is going to reduce our other income by $105.60. And we have miscellaneous income of $6,072.36. Okay, so we'll put those numbers in. Now, keep in mind as you're doing your underwriting, one thing that's very important is you have to make sure your numbers prove out. So the same way as if you're balancing a checkbook where you have to go in and make sure that your check register matches what's actually there, you got to do the same thing here. So our effective gross income is $799,149. So let's take a peek at our financials and see if we have the same number. So in this case, we don't, so something's off. But let's take a quick peek and see if we can figure out where that mistake was made. So it looks like here the difference is actually unallocated prepay, so I didn't have that factored in. So what we'll do is we'll place that in, we're going to put that in other income. The truth of it is we don't really know where that's going to wind up. So being it's unallocated, that's just a credit that's on the tenant's account that hasn't been actually applied to any type of charge yet. So for one reason or another, there's credits they haven't applied, and that's likely what our difference was here. So now it says 824,360, and as we look here at our financials, that's the number we have, so we're in good shape. Okay, so before we go any further, is everybody clear on that? You know, give me a head nod up and down if it's a yes, or a sideways if it's a no. Okay, so it looks like we're getting mostly yeses. So that's good. So if we have any questions, we'll answer those at the end. And now we'll take a look at the expenses. So normally on the expenses, you are going to do them on a T12 basis. In this case, we don't have 12 months of data. So what do you have to do? We have to annualize our numbers as well. Because keep in mind, if we're looking at 12 months of expenses and 12 months of income and 9 months of expenses, our deal is going to look a lot better than it should. So keep in mind, we want to have the same number of months for both. Okay, so now that we have 9 months of data on the expense side, what we're going to do is we're going to take our total number here, which is in column Q, and what we'll do is we're going to divide that number by 9. So the reason we're doing that is because we're coming up with a monthly average based on the information we have in the financials, and then we're going to take that total and multiply it by 12, so we're essentially extrapolating that total over a 12-month period. And we're going to run that formula all the way down the expense side. Okay, so now let's take a peek at the syndicated deal analyzer. We'll take a look at the expenses quickly. And let's look at the different categories that we have here. So we have advertising, contract services, gas and electric, general admin, insurance, legal, real estate taxes, trash removal, management fee, payroll, repairs and maintenance, turnover, and water and sewer. So everything we have on the financials is going to fall into one of these categories. Okay, so the first one we have here is management fees expense. So that's going to go right into our management fee line item, and that's $26,151.57. Okay, so next thing we have here is advertising. So that's going to go into its own category as well. That's $3,599.29. Okay, so next things we have here, we have a couple here that are going to wind up in our general admin category. So keep in mind, guys, general admin is intended to be anything that's used to run the business of the property. So if the property has a leasing office, if you go out and you buy printer ink, that's a general admin expense. If you're incurring any type of bank charge to run the property, that's going to be a general admin expense. So anything that's used to run the business operations goes into that category. Okay, so our next thing here, they're classifying as cleaning and maintenance. So they have here pest control, landscaping. I'm going to tell you these items here are generally contract services. So what's the difference here? Let's give some clarity between a contract service, repair and maintenance, and turnover. So a contract service is something that's going to be consistent in frequency and in amount. And it's probably something that you're outsourcing to a third-party vendor. And your most common contract services are typically landscaping and pest control. If you're looking in areas that have snow, then snow removal is also a common one. And depending on the underwriting tool you're using, you may also put trash in there. But pest control and landscaping are going to be your most common ones. So we're going to put these numbers here in our contract service category. So then repair and maintenance, what's that? So those are one-time expenses. So it could be, a pipe leaks in apartment 3 and you need to send somebody there to fix it. So that's repair and maintenance. It could be that you have a faulty wire in apartment 7. So that's repair and maintenance. Those are one-time things, regardless whether your on-site staff repairs them or whether you have an on-site contractor. But something that's one-time in nature and not recurring is going to be repair and maintenance. Turnover is something that's specifically incurred for the turning or make ready of a unit. So every time a unit becomes vacant and you have to get it ready for a new tenant, that's going to be called make ready or turnover. And your typical scope is going to be painting and cleaning. You might have some basic things that'll be on that, but usually anything extensive is more of an upgrade. Your standard turns usually painting and cleaning. Okay, so then let's look at our insurance. That's our next item here, and they're at $6,696. And I'm not sure about you guys, but it's been a long time since I've seen insurance at $67 a door, so they must have a great premium. Okay, so our next thing here is legal and other professional fees. So we have here, looks like total of $3,687.23, and we'll put that into our legal total on the syndicated deal analyzer. Okay, so our next things here we have classified as repair and maintenance expense. So we'll take a total here as long as all these items fit the bill. Now, keep in mind, guys, as you're looking at financials, every seller and every management company is going to do their accounting a little bit different than everybody else. So, one thing we'll see here is they do have a separate line item for make ready. So being that specifically classified as that, I'm actually going to break that apart and I'm going to put that into our turnover item. So sometimes you may need to move things around. As you're first starting out, just keep in mind it's more important to put it somewhere. You can always correct where it goes afterward. Just don't leave it out because that'll throw your numbers off. That's the worst thing you can do. Okay, so we'll take a total here of our remaining items and put them in repair and maintenance, and that's $21,129.20. Okay, so next thing we have here is supplies expense. It's tough to say exactly what that is just from the name, but I'm going to say it's probably a repair and maintenance item, so we're going to throw it in there. Sometimes you have to make an educated guess or just use the best information you have and put it where you think it should go. Okay, so next thing we have is tax expense, and we have this classified as other taxes. I'm going to go on a limb and say this is probably sales tax on some type of invoice that they put in its own category. So we'll just lump that in with repair and maintenance because it seems to be in that same sequence of accounts. Okay, so now for the utilities. So in the syndicated deal analyzer, we have separate line items for each of these. So water and sewer is going to have its own item. That's $45,394.13. And for electric, that's going to go in the electric and gas total. That's $5,990.21. And we have garbage. That's going to go in our trash removal item. That's $74.92.24. Okay, so next thing we have here is CAM. So when you see CAM, that stands for Common Area Maintenance. So that's just, it could be hallways, it could be breezeways, it could be any type of common area that exists on the property. So we're going to take these totals. They have one for repair and maintenance. We'll add that to our repair and maintenance total. That's $55,35.67. And the next one we have is utilities. It's tough to say exactly what that is, but I'm going to guess it's electric, so we'll put that in our electric and gas total. Okay, so now we have office expense. So they give us a couple of individual line items here. And as best we can tell, these all do appear to be legitimate office expenses. So we'll add these to our general admin total. And that's $22.95.31. Okay, bank fees, that's also going to be our general admin. So that's $298.76. Okay, next thing we have here is payroll. So we see here salary wages. That's going to go in our payroll total of $86,255. capital expenses. So capital expenses, it's tough to say exactly what it is from just looking at a spreadsheet with very little information. But what I would guess is that from the way they have it listed here, this should actually be what they call a below the line expense. So for anybody not familiar with that terminology, let's quickly take a look at our P&L tab here. So you'll see here a line item called net operating income. So anything that's recorded above this line, they refer to as an operating income or expense item, and that's going to be referred to as above the line. Anything below the line will be a non-operating income or expense item, and that's going to be, when you hear the term below the line, that's what it means. The only difference is that by hitting the NOI, it ultimately affects the valuation of the property. Even though you will impact the cash flow that's available for distribution to investors either way, you will not impact the valuation of the property if it does get placed below the line. Okay, so next thing we have here is miscellaneous rental expense. I'm going to put that in general admin, but that's strictly a guess because it's tough to say what it is based on that particular definition. And we have here eviction filing expenses of $6,281.33. And we're going to put that into legal. And the last thing we have here is actually bad debt. So in the big picture of things, it's not really a tremendous number, but this may sound strange if you're brand new. Bad debt is actually an income item. So even though they show it here in the expenses, we would want to treat this the same way we would any of the other income items and put it up top in the income. And we want to do it on a T3 annualized basis. In this case, our last 3 months have zeros in them. So it's actually going to lead to zero. And we're not going to do anything with that. So similar to the income, we want to make sure that our number proves out. I'm going to quickly delete this replacement reserve because that's really supposed to be a below the line item. But in the syndicated deal analyzer, they put it above. And what we want to do is make sure that our numbers prove out to what we see on the syndicated, on the T9. So in this case, we did make some adjustments to it. So we're going to take the total we have here of $258,381.33. We're going to subtract the bad debt expense because that's really an income item, so we didn't factor that in. And we're also going to subtract what they're calling capital expenses, so that way we can see if our total is accurate. Okay, so we have $248,007.92, and in this case we match up, so we're in good shape. Okay, so now keep in mind, guys, one thing that's important: if you have a difference with these numbers, take some time and find the difference. If it's $1 or $2, it may just be a rounding error, so don't go crazy for that. But if you're a substantial amount off, that's going to impact your underwriting. So make sure that you go back and try and trace the steps that you took to get to that point. Okay, so what we'll do now is we'll kind of dive into maybe some high levels. So this takes the data and puts it into the underwriting tool. So that's the first part of the process. So what's next? So the next thing is working forward to make some pro forma adjustments. And the first part is transposing data, getting the information accurately. Then the second part is saying, okay, how can we run the property going forward? And you want to use what the seller has as a starting point, but then you want to use the expertise of your team and your property management company to figure out what a realistic pro forma looks like. And that's going to be a combination of different things. You're going to reach out to them for guidance on where you might be able to push rents at a given property, what type of expenses you might be able to run the property at. So in this particular property, they're spending $27.30 a month per unit, $27.30 a year per unit. And overall, to me, that seems quite low. It's a low number for the Greensboro, North Carolina market, which is where this particular deal is located. Now, there are some smaller markets that you may be able to run that at. And if this is a smaller operator, and they're just using their own funds, maybe they could run it that cheap. But do I think we can run it this cheap? No, I don't. So being that we're going to look at it from a different perspective, always look at it at the lens that you're going to run the property through. So in our case, our primary strategy is syndication. So we generally will run the expenses a little higher. And because of that, we want to make sure we factor our underwriting in. two things that jump out to me right away, and I'm sure the first one probably jumps out to everybody, is taxes. So taxes are typically one of your biggest expenses, sometimes your biggest. So in this case, we have $0. Just by a quick head shake, does anybody think this property is paying $0 in taxes? Right. I'm seeing a couple of no's. I agree. So it's rare that you pay nothing in taxes. Keep that in mind. So in this case, what's happening? So a lot of lenders escrow for taxes and insurance. So because of that, what happens sometimes is that they don't get properly accounted for in financials. Sometimes it may also be a case that these guys are doing their accounting on a cash basis. They may have paid a certain amount for the taxes and the insurance at closing, and because it's on a cash basis, it's not properly represented in the financials. So keep that in mind. It doesn't mean that they're not paying taxes just because you don't see it, but it means that it's not included in their financials, so you may need to do a little more homework. So tax bills are accessible. You could always go on to county and city websites to find out what those bills are. Or in this particular case, there's a broker involved. You could ask the broker for it, get the information from them, and have them put the elbow grease in to sell the deal for you. So you can get that information. Now, also, as Jerry said, so something very, very important, and this is probably one of the largest mistakes that people make, especially as they're starting out. So keep in mind, guys, there's a lot of follow-up you need to do after you do your initial underwriting. The underwriting itself can be fairly quick. Where you spend more time is confirming all the assumptions you put in there. Underwriting is only as good as the assumptions you put in. So if you have bad assumptions, your underwriting is not going to make sense, even if it looks good. So what you want to do is you can use what the broker gives you on the tax bill as a starting point, but always reach out to the assessor in the county or the area that you're looking in to understand how their reassessment process works. So you want to understand when taxes are going to be reassessed, how that reassessment is going to be calculated, and whether or not it's a point of sale area that's going to reassess automatically after a sale. So being that many people in this room are probably focused in the Carolinas, if you're investing in North Carolina is not a point of sale state. So that means that they're not going to reassess automatically after a sale. Now, every county in North Carolina does reassess on either a 4 or an 8-year cycle. It would be nice if the cycles synced up, but they don't. So every county is a little bit different, unfortunately. So you need to contact the assessor and see, okay, when is that reassessment? Now, eventually, when their reassessment period comes up, they are going to take that higher purchase price into account and bill you in the reassessment for it. So this particular property is in Guilford County. I believe off the top of my head that their reassessment is actually this year in 2022. So what does that mean? That means if the deal winds up selling, this year, there's a good chance that sale price is not going to be factored into the reassessment, and you'll have a 4-year window until they reassess again before they really take stock of it. So that gives you some time. Whereas South Carolina is a point of sale state. So what does that mean? So that means when you invest in South Carolina, regardless of what county it's in, they're going to reassess you the next year. Now, the tax assessor wants their money right away, regardless of when their next scheduled reassessment is. They don't want to wait. They're saying, okay, you went in there and you paid a higher value. I want my higher value. So always keep that in mind, because that can make a huge impact in your deals. This particular property is a 100-unit property. Whether it's a 30-unit property, whether it's a 100-unit property, or it's a 300-unit property, these can be big numbers. And kind of the reason I'm harping on this so much, I want to drive this point home. There's times I've literally seen tax bills double and triple, and sometimes even quadruple. So when you're dealing with a 6-figure tax bill, that can really impact your deal. So just make sure you understand that and that you're really cautious on that. Okay, the other thing to me that jumps out here right away is insurance. Now, I see they do have some insurance expense, which is good. At least something's recorded there. But I'm fairly confident in 2022 that they're not paying $67 a unit. If they are, I want to find out who their insurance broker is so I can use them. But most likely, they're probably not paying that. So what you'll want to do is reach out to your own insurance broker, and you want to get what's called an indication. So at this stage of the game, when you're first taking your initial look at the property, you're not going to be able to get a firm quote. because a firm quote requires more information than the seller is going to give you. But you'll be able to get an indication, which is basically a high-level look and a soft quote. And what that does is similar to our underwriting, it makes some assumptions. So what most insurance brokers will typically do is they're going to quickly assess the crime in the area so they can see what type of liability rating you might have. They're going to assess whether or not the property is located in a flood zone. And they'll do whatever they can to give you a solid number to work with. What they won't be able to do is be aware of any construction defects that exist at the property. So, one thing that's common, especially if you're looking at older properties, which a lot of times I do, you may see aluminum wiring. So that's something that insurance companies frown upon. And unfortunately, there's no way for an insurance broker to know that right away. So unless you tell them that, which most likely you're not going to have that knowledge at the beginning, then that's something that may wind up adjusting your premium as you go through the process. If the seller has claims in their loss run history, that's something else that could also negatively impact insurance pricing. But again, you're not really going to know that most times until you're on the contract. So all you can do is work with the information you have and get the best assumptions you can, so that way your underwriting is as buttoned up as possible. Okay, so then the next things I would do is I would reach out to the property management company I was going to use, and I would speak with them to see, okay, where can we run this property at? So from being familiar with the market, there are some things that strike me a little bit off. Some of you guys are probably aware of this, but in the last year, wages have risen across the board. So what does that mean? People are getting paid more. Payroll expenses up in terms of our underwriting. They're at $863 a door. To me, that seems like a pretty low cost for most parts of the Carolinas where you have full-time staff. And by the point to get to 100 units, which this property is, I would think that you probably have 2 full-time people. There's a good chance that you have a full-time manager, and you probably have a full-time maintenance person. So if that's the case, you're going to need money to pay for that. Even if you're getting people at somewhat of a discount, you're probably at around the 110, 120,000 for that. If you want good people, they're probably going to cost you more than that. So keep that in mind. 86,000 may be a little bit low, but always discuss with your property management company to see what they think is feasible. Same thing with some of the other expenses. So you want to use their expertise, and ideally you want to have relationships with property management companies that are already managing in the areas that you're looking at. That way you can use their wisdom, you can use the intellect that they've already gathered, and then make good informed decisions based on that information. Okay, so another thing we'll touch on as we kind of go forward here is financing. I know that's something Jerry touched on in his presentation earlier because it's a very important aspect. And it's also something that's very volatile right now. So for anybody in here that hasn't been keeping in touch with market news the past couple of days, weeks, months, we've had a lot of changes. Interest rates have been rising. They've been rising a lot. And unfortunately, sometimes the terms that you get when you first look at a deal are going to be very different than the terms you wind up with now as you close it. That's not always the case. This is a very unusual time in terms of volatility, so keep that in mind, guys. That just means you have to be aware of what's going on that much more. But there are times when you can get a financing term sheet early on, and your terms will be fairly close to that. Right now is not that time. So what I'm going to do is, even though it doesn't pertain to this deal, I'm going to pull up a real term sheet from a different deal, just so you guys can see, what these things look like. And this is a fairly recent one from, 3 weeks ago, June 20th. Now, when I say fairly recent, let me quantify that. That's in normal times. June 20th to now in this particular market is totally irrelevant. Okay, so let's look at where things work here. So for this particular deal, this is from a mortgage broker that I deal with on a regular basis. He's giving us 2 different options. So when you see the term debt fund, that basically means you're getting bridge debt. Now there's 2 different options here that he's giving us. One is floating, which means it's an adjustable rate. The second would be fixed. So you can use whichever option you want. Some deals, depending on how the underwriting shakes out, they may also qualify for different options like agency debt. For me personally, agency debt would be my preferred choice of debt, but it hasn't really been a great option in recent times because proceeds are too low, and that's because pricing is too high. So even though pricing is coming down, it probably still has to come down more before agency debt can really be relevant again. If you have people that are willing to sign recourse, then banks and credit unions are probably going to be your best financing options right now. They're going to give you your most competitive terms in terms of both proceeds, rate, and overall package. But there's also more risk because if something goes wrong and you sign recourse, that's a lot more liability for the guarantors. So just keep that in mind. Okay, so let's take a peek here. So what information do we have on a typical term sheet? So they're going to give us proceeds, and this is going to be based on a combination of the purchase price. In this case, is bridge financing, so it's also including some money for CapEx, and it's also going to be based on how well the deal underwrites in the past performance. So it's telling us here initial proceeds. This is what we would expect to get at closing for this particular deal. So you'll notice they're giving us a range. And the reason they're doing that is because the market is very volatile right now. So as interest rates change, that could impact the amount of proceeds we get. If interest rates go up, proceeds are probably going to go down because the lender has to maintain a certain debt service coverage ratio in order to satisfy their requirements. Future funding. So this is something that's usually more unique to a bridge loan. You can find some other loans that'll do it, but a lot of times bridge. This is typically for CapEx. So many bridge lenders out there are going to give you 100% of the CapEx funding. And what they typically do is they work like a construction loan where they do it on a draw schedule. So each month you're going to have to go there and submit a requisition. They're going to say this much work was done. They're going to check it off to make sure you actually did it. And then they'll release whatever amount of dollars is related to that particular request. Okay, so now they're showing the term. So the term is how long your loan is. So in this particular case, it says 3 + 1 + 1. So most bridge loans typically have 2 or 3 year terms. If you're looking at loans that are $5 million or less, you'll probably see 2 or 3 years. Generally, if you're above $5 million in loan amount, you're probably going to be a 3-year term. And most of them have either 2 6-month or 2 12-month extensions. So in this case, they're proposing initial term of 3 years and 2 12-month extensions, which would be additional years. Now, keep in mind, guys, just because a loan has extensions doesn't mean that the lender is going to let you use it. They're going to review the request at that time if you choose to use the extension. They're going to see how the loan has performed in the past, and they're going to make sure that both the property and the borrower are just as strong, if not stronger, than when they initially took the loan out, because they want to make sure that their probability of getting repaid is high. Okay, so they're showing here an index. So an index is the base of the interest rate. So in this case here, most loans at this point track the SOFR rate. And what you'll see is that there's different SOFR rates out there. The one that most of them are using is called the term, TERM, SOFR, SOFR. And the reason they use that one is because it's forward-looking. So obviously it can't take everything into account because none of us have a crystal ball. But what it tries to do is incorporate some of the current and future sentiment in the marketplace. So that way it looks ahead and captures some of that so you don't have as big of an increase as you would from a past average. The spread is the portion that the lender's actually making. So this is the lender's portion of the interest rate. So in this case, they're saying 4.25 to 4.75. In most cases, you're probably on that 4.75 side now because more lenders are getting a bit nervous. And as that happens, that means they want loans to be more worthwhile for them to issue. So in order for that to happen, they have to make more money on it. So the interest rate is the total of both the index and the spread. So if you total these two numbers up, that gives us the numbers we have here in the interest rate. Okay, so when you see here years of IO, that's interest only. So this is how much interest only you can factor into your underwriting. Amortization is how long the payment schedule is spread out over. So even though you have a 3-year term, if you had a 30-year amortization, what that means is that you're not repaying the full balance of the loan over a 3-year period. What you're doing is you're paying it down month by month as if it was on a 30-year schedule. And then at the end of the term, you have what's called the balloon payment, which is whatever the outstanding principal balance of the loan is. Implied LTV, so this is loan to value based on the loan amount. And stabilized debt yield is typically by year 3, it's the basically it's a metric the lenders use to determine how safe the loan is. So nowadays, most of them want somewhere between 8 and 8.5, and this is something that's been steadily increasing as interest rates rise. So that's kind of a high level on it. Jerry, do you want me to dive into kind of working forward with some of the pro forma, or would you want to open up for questions?
Let me unmute myself. No, this was perfect. This was awesome. I think I don't want to get too deep into the numbers. I think this was a great walkthrough of the process of starting from data entry and then what you look at specifically. So I think it'd be a perfect time to jump into questions.
Good. Okay. Hey, let me make you the host. See, we'll take that over.
Cool. So I guess while we wait, I'll kind of jump in with a question that I have. One question when you walk through the process of, obviously if you get a deal under contract and you have all these expenses and all of this that you're looking at these numbers, there's obviously the trust and verify, right?
Right.
Realistically, though, how deep can you get into these figures? Can you get into statements and invoices, or do you basically understand like there's a ballpark that you're going to take that certain number as what it is because you're not going to get as much information as you want?
It's a good question. So the native New Yorker in me always says don't trust anybody. But that being said, so the answer is you want to get as much information as you can. And that can vary from seller to seller. You'll have some sellers who are very free with information, and you'll have some who will want to give you next to nothing. So at the bare minimum, we're going to take the trailing financials. If we can get bank statements, we do ask for them. A lot of sellers give resistance and do not like giving them, but you'll find some that might. If you have a property that has really haphazard collections and things don't seem to be consistent, it may be good to really insist on the bank statements because that's something that will help you see what's going in the accounting fund. And you can see if that lines up with what's on the financials. And if those numbers match or come close to it, you're probably okay. If there's a big discrepancy, that could be an issue. Another thing I would also recommend, even if you can't get bank statements and you can't get anything beyond just trailing financials and operating statements, in our contract, one thing we always do is we require the sellers to affirm that, to the best of their knowledge, the financials are true and accurate. And basically what that means is if we find out that they're not, then potentially that could be a reason for the seller to default and us to get out of the contract and get our money back.
I guess before I turn it over, anybody else just jump right in. How about, especially I think right now is next time where with rates moving where they are, things are going to get a bit tighter, and the operator, those who can go in there and find inefficiencies in the expenses and reduce expenses, is not just going to be about, rents running up. What are some of the numbers that you look at that you immediately, a lot of times when you're looking at deals, and especially, if it's more of a mom and pop operator where you say like, oh, that's just too much, or that number is just, not right. Like, what are some of the typical numbers that you can jump at?
It's a good question. So I'll answer the question first on the basis of a mom and pop operator because that's an interesting perspective. I usually find one or two things with mom and pop operators. One is they run the expenses very low enough to the point where if I'm running a syndication, I probably can't run them that low. Maybe there's certain things they're skimping on that I wouldn't recommend skimping on with a syndication. And the reason for that, keep in mind, guys, is even if you could run something cheaper, most investors want to feel good about what they're investing in. So that's part of the appeal of syndication. And then the other extreme I see with mom and pops is that they have so much in the expenses. And usually the reason for that is because they take whatever CapEx items they have, and instead of breaking them out and putting them below the line, you see a repair and maintenance number that's $100,000 higher than it should be. So the first thing I do whenever I look is I go back to the broker or the seller, if you're dealing with the seller directly, and I question them on things. So I never want to arbitrarily assume I can lower something without understanding the context behind it. So keep that in mind, guys. That's important. You could assume you can lower something, but you may not really be able to unless you know what the underlying root cause of the issue is. So once you understand why something is being run the way it is, then you can make an informed decision and say, okay, I can actually lower this, and this is something we can cut right away. So one example is we were looking at a property in Virginia about 2 weeks ago, and that particular property was a 208 unit property. It had a payroll expense of $346,000, which was something like, if you have the top of my head, maybe like $1,700 a unit. So that's pretty high. So my first thought is, wow, they have a lot of people at this property. And so my instant thought is we can go in there and we can probably get rid of a person or two and bring the payroll down to a more normal number. But always make sure you have to question why they have so many people. Is there something that they know that I'm not aware of? Maybe they need that many people. So what we found out after contacting the brokers, that it was just the way the seller chose to run the property. You don't really need that many people. So after conversing with them and with our property management company, in our underwriting, we underwrote it at $244,000. So that was $102,000 less than where they had it. And it was a number that our property management company felt good at based on their experience managing other properties in the area.
Good. Anyone else have any other questions? Check the chat.
I think I fell asleep when you were talking about the difference between spread and interest rates. So could you please go over that again?
Yes, absolutely. So the index is essentially what the rate is linked to. And for most loans, they're going to be linked to what's called a term, TERM SOFR rate. And that's a forward-looking version of the SOFR rate that accounts for some futuristic pricing. The spread is the lender's portion of the interest rate. And when you total both the index and the spread together, that's going to be your total interest rate for that particular loan.
Okay, thanks.
You're welcome.
Anybody else? Don't be. I have lots of questions, so I can always throw more out there.
Hey, Charles, did you speak on sponsorships at all?
I did not, but we can. So when you're talking sponsorship, you mean for the loan, correct?
Yeah.
Yeah, so for sponsorship, what you're going to need with most lenders is you're going to need a net worth that's equivalent to or greater than the loan amount. Now, keep in mind, every lender is going to have different requirements, but these are kind of basic parameters. And these requirements can be from multiple people. So if you have, let's just say, a $10 million loan, and you have somebody in your team who's worth $5 million, but they couldn't qualify on their own, well, then maybe you bring in somebody else who's worth $3 million and somebody else who's worth $2 million, and now you hit that requirement, so you're okay. Similar to net worth, the lenders are also going to have a requirement for liquidity. And that's going to vary from lender to lender, but a lot of times they're going to want to see anywhere between 9 and 12 months of debt service. So that means if your debt service for the year is $300,000, they're probably going to want to see $300,000 in liquidity between the sponsorship team. Another thing they're also going to look for is most lenders do want the guarantors to have some skin in the game. So they're going to tell you that, okay, you need to have X amount of dollars in the deal as equity. And most times that number is going to be between 5 and 10%. But that, again, will vary from lender to lender. So those are the important things they look for. And they also look for track record. So one thing that's important to lenders is they want to make sure that they're funding people that have done this before. And the reason they like doing that is because it increases the probability that the loan is going to be repaid, and it gives them a better chance of just having a successful experience with it. So usually somebody on the team is going to need to have experience with it. And and pretty much all lenders also like to see, in addition to just general experience, they really like it when somebody has experience in that particular area. So if you're investing in Greensboro, North Carolina, or Greenville, South Carolina, and you have a KP that's already done deals in that market, that looks even more favorable.
Thanks, Charles.
You're welcome.
So Charles, I know like many of us invest both as limited partners and could be active. So so in some deals you can go in as a limited partner and you're dealing with another syndicator. Or I'm curious, what are some of the underwriting questions that you get as a sponsor or an operator after you put a deal out?
Good question.
And then what are the questions that a limited partner should be asking a sponsor?
So one of the big questions, if it's not in the investor presentation, is terminal cap rate. and that's a good one that a lot of people probably should ask about. So aside from purchase price, terminal cap rate is the second biggest influencer in the deal. It can literally make or break your return. That's how important it is. So especially right now, because we're in a market where cap rates are moving. So keep that in mind, guys. You're going to get asked that question a lot. Another thing that you're going to hear is that people want to understand what's the risk associated with the deal. Especially right now as we have some uncertainty in the market, people are nervous. So they want to know, how safe is my investment? If I give you $50,000, what's the probability that I'm going to get my $50,000 back? So break-even occupancy is probably something you'll hear a lot. People want to understand, okay, how bad do things have to get before we can't afford to run the property and we have an issue? Another common question is distributions. Investors like to know when they should be expecting to get paid, at what frequency, and typically when they're going to be starting. That's probably one of the more common questions I usually get. And I think that's understandably, it's the reason most people are investing, so probably an important one. For me personally, when I look at deals, one of the things that I always zone in on, so there's three components to any deal. You have the sponsor team, you have the area, and you have the property itself. Of those three things, I would tell you the property itself is far and away the least important. I don't want to say it's not important, because that's not true, but it really isn't. You're kind of investing more with the sponsor team than you are in the individual deal. So I would make sure that I feel confident in whatever team I'm investing with, because that's going to be an important thing. To me, I'd rather take a team that I feel confident with that's offering me a 14% return than a team that I don't feel confident that's offering me a 22% return. And the reason for that is because, oftentimes it's said that a good team can take a bad deal and run it well, whereas, a bad team can take a good deal and run it into the ground. So that there's a lot of truth to that. So invest with people that you feel confident with, either people that you invested with before, that you've heard good things about, that you get a good vibe from just from doing your own initial diligence, and also invest in areas you feel good about. The area is far more important than the property, because the operator can change the property. They can't change the area. So if they're investing in an area that has low growth, and it's an area that's a rougher area and it doesn't really show much sign of turning around, there's a chance they may have some difficulty running that property. So be aware of that. To me personally, if I was going to invest passively, I'd be more inclined to invest in bigger markets, just because there's more stability there. Now, you can get better returns sometimes from those tertiary markets, but you're getting better returns because there's also more risk. So keep in mind, guys, especially as market conditions change, big markets like Charlotte, like Atlanta, like Orlando, those markets are going to hold up pretty well. Are they going to see some downward action? Probably, but it won't be nearly as much as a smaller tertiary market. So the tertiary markets are usually the last ones to come up in an up cycle, and they're probably the first ones to go down in a down cycle. So just keep that in mind. So that's generally what I would look for if I'm investing as an LP. Strong sponsored team I feel good in, preferably a bigger area, especially now with some of the uncertainty that's happening, and just a sound business plan. I think those things can get you a long way, and that'll get you generally to a safe investment.
Great answer. Good. All right. Anybody else have any questions?
Hey, Charles, just to double down on the cap rate thing. So is there a queue you're going to see, like a certain cap rate you're looking for? Is it just like, as you talk to brokers and deals, as the prices make more sense, you're kind of like, oh, okay, now it's time to jump back in?
Realistically, it's going to wind up being mostly speaking to brokers and just kind of conversing. So the challenge right now is prices change fairly quickly. What you're going to see is that cap rates are also going to follow suit. So, the downside to services like CoStar and Yardi Matrix, and again, they're great services, so I'm not knocking them. But the problem is that data is always in the past. So the issue with that is you're seeing cap rates that were relevant 3 months ago. And the cap rates that were relevant 3 months ago aren't really relevant now because they're rapidly changing. So last year, what was happening is cap rates kept compressing. So as soon as a transaction closed and that cap rate was on the books, there were already newer transactions on the contract at lower cap rates. And now we're seeing the opposite. So cap rates are decompressing. So what's happening is all of a sudden the numbers that are on the books and in the CoStar reports become somewhat irrelevant because now there's newer deals that are on the contract right now as we speak that are selling at higher cap rates. So conversations with brokers are really going to be your best resource to understand what the cap rates in the area are at that time. And, just being aware of what's happening in the market and the bigger economy.
Awesome. All right, so it's at the 8:40 mark. I appreciate your time. So typically I keep it to an hour presentation, and then what I do is break up into breakout rooms and do some networking. For you and the presenter, I appreciate it. So you don't need to stick around, Charles. It was awesome having you here. One thing, Charles, you put your information already in the chat, right?
Yes, I'll put it in there again if anybody wants it.
Yeah, please do. You're gracious enough to host every Saturday at 4 p.m. an underwriting session where you go even further than what we did today into the pro formas and to whether or not it's a good deal or not. So anyone that's looking to do that, please reach out to Charles. It's a great resource, and he's got all the answers, right, Charles, on the underwriting.
I'm not going to say all of them, but I appreciate the vote of confidence.
And so I guess one last thing before we cut into that, whoever, hangs around here, it's a good conversation. How much a lot are also, a model spreadsheet, right? Once you get the deal, it's a snapshot in time, but how much is also a lot of it gut feeling and just really understanding the market than necessarily
probably 40 or 50% of it. And keep in mind, guys, your underwriting is always a living, breathing document. So it's not something you do once and you stop, because every time you get new information, you have to come back and you have to update it. So it's going to change multiple times throughout your process. If you get a deal in the contract, it may change 10 times from when you first look at it until you close on it, because you're going to keep getting new pieces of information, then you have to update it to see what your deal looks like at that point.